now 5 years into the start of the financial crisis, and if you look at how things have panned out, unfortunately not very differently from what we saw 2 decades ago in Japan. For example, growth is still fairly anemic, inflation is still fairly low, and monetary policy really hasn't had an impact in terms of kickstarting real economic growth. So if you look at the global growth, maybe with the exception of the United States of America, unfortunately the picture is not a pretty one. There are several economies in Europe that are in a recession. We've seen a dramatic slowdown in terms of the growth rates in China, really on the back of slower exports to the likes of their trading partners in Europe. Secondly, I think another factor that's definitely played a role in terms of investors' expectations, certainly from a South African investor's point of view, is the significant increase in strikes that we've been having in South Africa, which started particularly on the mining side, but has now become a lot more broad-based. And that will have real consequences. Firstly and foremostly, it will have an impact in terms of increasing the real costs for the mining companies, where over 50% of their overall costs are in fact salaries and wages. And secondly, obviously an impact from on GDP growth through reduced production. Another important factor that I think has played out during the quarter is an improving return, certainly for investors that follow a value-orientated style. So while we saw a big improvement in our overall performance towards the end of the quarter, when you look at it year to date, the value-orientated style still is lagging the growth-orientated style. And that will continue to be the case for as long as we see fairly low and depressed levels of growth. When we look from an outlook point of view, there's probably 3 things that are receiving our attention at the moment. The first and foremost is obviously this dramatic response that we've seen from a monetary stimulation point of view. We've seen the United States of America come out with another round of quantitative easing, which in essence is a perpetual quantitative easing through a buyback of roughly about $40 billion worth of mortgage-backed securities each month until we see a sustainable improvement in employment levels, which from our point of view could be some way away. They're not alone. We've also seen additional quantitative easing from Japan and similarly measures in Europe as well. But the bottom line is, unless these measures can translate into real economic growth flowing through, then we think the equity market has probably run a little bit ahead of itself. Secondly, one of the important things that I think we're going to hear and read a lot more about over the coming months is the so-called fiscal cliff in the United States of America. There's a bill that is coming into effect at the end of this year, which translates into a reduction of previous tax benefits that the US citizens have had, as well as a number of projects, infrastructure projects, coming to an end. And unless we see those being replaced, it could translate into a dramatic decline in GDP growth for the US, which would be a huge disappointment because they are the one economy that seems to be gaining some traction in terms of their economic growth. Thirdly, especially again given the role that commodities plays from a South African investor's point of view, you have to look to China and the importance of them coming through this slowing rate of growth without any huge disappointments. And we've already seen announcements of additional infrastructure projects coming through, and so far the data that we're seeing coming out is that this is starting to have a positive effect when looking at the leading indicator, which has now turned from very negative and very depressed levels now into positive territory. And if that continues to gain traction, certainly once the elections in China are behind them and we see more of these measures coming through, we think that bodes particularly well for commodity prices and obviously commodity stocks going forward. A big contributor to our returns over the last quarter has in fact also come from our offshore exposure. We have a fairly concentrated portfolio of 5 stocks offshore, focusing largely on companies that are listed in developed markets but have significant and rising exposure to emerging markets. And from a valuation point of view and looking forward, to us we still see substantially more attractive opportunities in the likes of a Tesco, which is a retailer, food retailer in the UK market, trading on price to earnings multiples of 9 times, versus the alternatives in the South African market, like a ShopRite, which is trading on a 25 or 26 times PE multiple. So in conclusion, we've already seen a very positive response from equity markets, not only in South Africa but around the world, to the monetary as well as fiscal responses of governments to try and stimulate economic growth. The risk for us is twofold. Firstly, in some respects, we think that sectors of the local market have run well ahead of themselves. In particular, the industrial sector, from our point of view, has never looked ever as expensive as it does today. Within the industrial sector, the retail stocks, for example, stand out as being exceptionally overvalued. So we would be very cautious and stay away from those sectors of the market. Secondly, if we don't see a positive response from an economic growth point of view, the improvement in equity returns may be short-lived. The other point that is quite important to bear in mind, as a value investor, we focus a lot on the stock picking. So while we believe our clients will benefit from an overall improvement in global and local economic growth, each one of our underlying investments has a specific asset within the portfolio that we believe is undervalued. So for example, Old Mutual, there's a significant undervaluation attached to the international life business. If you look at Steinhoff, for example, again, and you strip out the local assets which are now priced, like JD Group and CUP, the implied valuation on the European business, in our view, is far too low. And so clients will see a benefit as the valuation gap in those underlying assets continues to close. And I think finally, when you look at the attractiveness of equities versus other choices that clients have to invest in, whether it be bonds or property or cash, based on our assessment of the growth rates as well as the starting valuations for equities right now, we still see equities as delivering better returns, certainly when compared to the likes of property and bonds, which have had significant tailwinds in the last 12 to 18 months.